It's not every day that we get Ralph Schlosstein. He's the president and CEO of Evercore Partners and also the former NYSE chairman Dick Grasso on together in our studio here. They can both talk about one of the biggest deals going on right now, right, which is the tussle for the New York Stock Exchange between the Nasdaq and ICE and Deutsche Boerse. They both want the NYSE. Ralph's firm, if you may or may not know, is an advisor to the Nasdaq on this bid. Ralph, I just want to start with you, and I know there's some things that you obviously can't talk about, on this. I'm trying to say some things, Ralph, but overall, what some are saying, those who are in favor, right, of the NYSE and Deutsche Boerse deal, is how can the Nasdaq, the NYSE, and ICE, how can they actually make New York and the NYSE and a combined entity more globally competitive than other exchanges around the world that are consolidating?
Well, first of all, the New York and Nasdaq combination would already be somewhat global. And second of all, I think we all have to recognize that New York and the U.S. has been losing out in the battle for listings globally. And it's not at all clear that a plan that has the largest exchange here in the U.S. owned by a non-U.S. entity isn't going to further that process. So I think a lot of this is about keeping America's capital markets competitive in the global economy.
Dick?
Well, I think the fundamental question that investors in NYSE Euronext are going to face is, do they accept this premium bid that Nasdaq ICE have put on the table, or do they accept the strategic vision of the Deutsche Boerse NYSE management that says, over time, we're going to build a franchise, a global franchise that has enormous incremental value to those who stay with us. And I think, as Ralph said, the marketplace is global. The investors will have to make that decision. I don't think it's a matter of asking the question, how can New York be taken over by a non-U.S. player? I think that...
You don't think that's the question?
I don't think that's the appropriate question. I think the appropriate question is, how do you, as an exchange operator, globalize your franchise across geographies, across products, and most importantly, I think, in the back end of the business.
But, would it be easier, though, and Ralph, I know you disagree, but would it be easier, though, if you did pair up with an exchange overseas, then, to become more globally competitive for the NYSE?
Well, New York has already paired up with Euronext. Okay, Euronext was a player in multiple markets in Europe. I think the one piece missing from the equation, whether you look at the ICE Nasdaq bid or the Deutsche Boerse consolidation, is what comes next. And what comes next must be a PAC Rim affiliation, whether that's Hong Kong, Tokyo, pick the venue. But to truly be a global market, you need all three of those arenas sitting under the same franchise. And I think that, it's a very interesting prospect that we face as a U.S. capital market. Ralph raises the right question. So many IPOs have gone elsewhere because of regulation, whether it's securities regulation, whether it's Dodd-Frank, whether it's Sarbanes-Oxley. A lot of competitive capital markets have said, stay away from the United States. That's wrong.
Dick, I remember last time you were on the phone with us about this, you said that, you thought that the price would get bid up and bid up on the NYSE, and that hasn't happened. I mean, the Deutsche Boerse didn't come back, Ralph, right, with a higher bid. So, are you surprised to the extent that Duncan Unirout and the NYSE rejected it outright without trying to seek, I guess, more information from the Nasdaq, and now that it's turned hostile because of that?
Well, now you're getting into an area that we're not going to discuss on the air, the deal tactics and things like that. So,
okay.
Okay?
I would only offer, as a non-participant either side, the wisdom of Yogi Berra. It ain't over till it's over. And I think that there is still yet to be seen the real price that will be paid here. Okay,
then let me ask you a more, Ralph, on a final note, a just sort of overall question, though, on this. If there was, in fact, a Nasdaq NYSE deal, though, does that leave the combined entity still vulnerable, do you think, to more acquisitions from other bigger domestic competitors?
I think I would actually go in the direction that Dick went, that ultimately the globally competitive exchanges will have a significant presence in the United States or North America, in Europe, and in Asia, and that in either case, whoever ultimately prevails here, this will be yet another step toward that ultimate goal. So it's not that one transaction is strategic and the other isn't. I think they are different strategic paths to what ultimately will probably be the same place.
Dick, let me just start off with you, very quickly on this, because you've seen some of the investor reactions to this. They react to the headline number, but some said the markets have gotten, in some ways, ahead of what the jobs market really is about. Do you think that's the case?
Well, I think it's important to not focus on one particular month's report, Betty. Market is up 25% year over year, and up 100% off the March 9 bottom. And we're in a perilous, shaky recovery. We've had enormous external events, whether it's the earthquake in Japan, whether it's Europe and the credit quality of some of those countries, whether it's the Middle East and North Africa, and certainly the budget debate here in the United States, debt and deficit. So the market is skittish, but the market, I think, is telling us something. Up 25% year over year. I think the numbers today have two signals, one a very positive, one a neutral to negative. I would say to you, let's look at the end of June and take a measurement there.
You mean after the Fed pulls out their QE2?
Exactly right.
Why don't you think big companies are hiring right now, or hiring as much?
Well, I think CEOs looked at the first 4 months of this year and saw all of the turmoil, whether it was governmental turmoil, whether it was natural catastrophes, whether it was the spike in commodity prices, and basically pulled back. They're looking for clear policies that will initiate long-term growth solutions back into this economy. Just a point on David's commentary a little earlier, I'm not sure that we're in a period that can be compared to prior recessionary cycles. We went through a housing implosion and a financial meltdown, the likes of which we haven't seen since the Great Depression. So I'm not really sure there is a normal comparator as to where.
So you're willing to give a little leeway to this recovery then?
Absolutely. Absolutely. I think the market is telling the story. The market is saying 6 months from now, this economy is going to be a lot stronger.
So, flash crash, today is the first-year anniversary of that. Have we done enough to prevent another flash crash?
Well, I give the SEC and the CFTC a lot of credit because they've initiated a series of circuit breakers and shock absorbers designed to hopefully prevent the type of volatility we saw a year ago today. The American investing public will not accept a stock going from $41 to a penny back to $40 in the course of an hour. And that's what happened to Accenture. I think the SEC's implementation of individual stock limits, very important. Are we out of the woods? You'll only know the next time the market breaks. The next time there's a break, you'll test these speed bumps. The good news is I think the SEC is prepared to do whatever it takes to change those speed bumps, to slow the process down. But most importantly, what Mary Shapiro did after a year ago today was she got all of the markets together. And she said, if you trade the same product, you must have the same rules. They didn't a year ago, and thus the flash crash.
Well, it also speaks, Dick, right, to all the interconnectedness of markets, because it was not just the futures markets and stock markets. All the markets seemed to work together. There was some question about whether or not it was one big futures trade that set the whole thing in motion, or whether it was stock trades that did. And there's no definitive answer as of yet. But how much have they taken in terms of steps to kind of get everybody to cooperate interagency-wise?
Well, they took a page from Francis Ford Coppola. All right. They made the markets an offer they couldn't refuse, okay? I think it's important to recognize Take IBM, for instance, or take Intel. They trade in 80 different venues, okay, competing for price discovery. You have to have the same rules in all of those places. We didn't a year ago, and the flash crash was the result. I think we do now. I think there is symmetry, but the SEC has said very clearly, this is not a finished product. We're going to look at periods of hyper volatility, and we're going to do whatever we must to make sure the American public doesn't get hurt.
Right. Certainly, this is something that we're going to be watching, and there's all these questions about, as you say, time will only tell. We won't know if we're going to get into another flash crash when it actually happens. Another topic that we've been covering this morning, Dick, is Goldman Sachs. They've got their shareholders meeting, and pay is going to be certainly the controversial topic, on the top of the agenda for the shareholders. I know Dom's been covering that story for us. You, of course, have your own history and the controversy with pay packages, but I'm trying to get a sense, the lessons that you learned from your own situation, how you feel about Wall Street pay now.
Well, I think that shareholders of public companies, and obviously Goldman is a public company, have no problem whatsoever compensating a CEO for a job well done. And Lloyd Blankfein has done a remarkable job guiding Goldman Sachs through the most perilous period in financial markets in the history of this country. I think where the public gets upset with compensation is when compensation is awarded and performance doesn't fit that award. Now, if you were Lloyd Blankfein,
and you don't see that at Goldman?
Absolutely not. I think he's done a masterful job. The stock has performed well. Perhaps not where it once was, but this is a different period. I think he's guided the firm into products and into risk management tools that make it a much better place today than 2 years ago.
Is say on pay the right way to go? Do shareholders or should shareholders have to be involved in kind of check marking or signing off on a pay package for an executive?
I think it's a feel-good kind of a thing for particularly institutional shareholders. But, Dom, the real litmus test is if the CEO is overcompensated, fire the board. The CEO doesn't write his own check. The board, the compensation committee, are responsible for that. Throw them out, as we did to the Dodgers.
Is there anywhere, though, on Wall Street where you think the compensation, though, is out of whack?
Well, I think certainly when you hear, and you don't see the names because they're not CEOs of firms, but when you hear of traders, proprietary traders, making extraordinary amounts of money, and I'm not talking about the levels that Blankfein earned, I'm talking about multiples of that level, but they were betting the house capital to do that. That's where you begin to take issue. Now, again, set that in context. If you're in a private firm, I mean, no one takes exception to the fact that there were probably a dozen hedge fund managers last year that earned in excess of $2 billion. $2 billion. If Lloyd Blankfein were running a hedge fund, he probably would have earned $3 billion.
So it's about public versus private then, right? Having public capital at risk versus your own money to lose at risk.
Exactly right.
So when you see these headlines come across, Dick, then, Senator Levin, is going to, recommends the SEC and the Justice Department, look closer at Blankfein and at Goldman Sachs, and perhaps there was perjury involved in here. What goes through your mind then? You think this is a witch hunt or what?
Look, I think we're in a very difficult period in terms of public confidence in the capital markets in this country. We've seen a massive meltdown, starting in the housing market, the mortgage product, derivatives that no one really understood but marketed aggressively and watched portfolios implode. The public, rightfully so, is anxious and sore at Wall Street. Okay.
Well, they feel they put their money in, and these guys are making great money, and now what?
Right. But I do think we have to step back. You don't throw the baby out with the bathwater. We have the best capital markets in the world in this country. Do they need change? Absolutely. I think we've got aggressive regulators at all levels, in all venues, that are pursuing that right now. But let's not give up what we have and no other country has. All right, a capital raising mechanism that doesn't have a comp.